welcome to today's Explainer. You know, the financial world over the last 24 hours has been, well, nothing short of cinematic. It's really a story of incredible contrasts. Think of it this way. If yesterday's CPI data was this sudden loud crack of thunder that made everyone jump, today's producer price index, it's like a refreshing, heavy rain that just triggered a massive domino effect across the entire global financial system. We're looking at a tale of two very different spheres colliding in real time. On one side, you've got a jubilant, celebrating Wall Street, and on the other, a fiery, incredibly complex geopolitical situation over in the Middle East. Let's dive right into it.
Okay, to truly grasp this massive domino effect, we've got to start with one specific kind of mind-blowing number, negative 0.3%. This right here represents the month-over-month drop in June's headline producer price index, or PPI. Now you might be wondering, why is a fraction of a percent so shocking to the financial world? Well, because heading into this report, the entire market, including top financial analysts, they were bracing for a flat 0.0% reading. They fully expected wholesale prices to just, stagnate. But instead, we got a sharp, undeniable contraction. That negative 0.3% literally shattered expectations and sent an immediate shockwave straight through the trading floors.
All right, part one, closing the inflation shock.
So unlike the terrifying inflation shocks we've grown all too used to over the past couple of years, where prices spike and markets absolutely panic, this was a distinctly positive shock. The relentless, suffocating pressure of rising prices at the manufacturing level suddenly snapped. This single data point basically opened the door for a total shift in market psychology about where our economy is headed next. The year-over-year headline PPI has fallen steeply down to 5.5%. That is a massive step down from its 6.5% peak just a month prior in May. It paints a beautiful picture of rapid cooling. But hey, as an astute observer, you always have to look under the hood, right? The core PPI, which strips out the volatile food and energy sectors to give us a baseline, actually ticked up just slightly to 4.7% year-over-year. That tells us that while the headline is fantastic news, the underlying price pressures haven't completely vanished just yet.
Which brings us to part two, the white swan event.
So, if core inflation is still a bit sticky, what exactly drove that massive drop in the headline number? We are looking at what analysts refer to as a white swan event. Now, for those who might be unfamiliar, a white swan is quite different from a completely unpredicted black swan. A white swan is actually somewhat predictable. We know the actors involved, we see the simmering tensions, and we can map out the potential outcomes. But when the event actually unfolds, it still brings an immense, rapidly shifting impact to the global markets, positive or negative. It changes the mathematical equation for traders instantly.
In this case, the specific white swan development is the US-Iran ceasefire agreement regarding the Strait of Hormuz. Look, the Strait of Hormuz is undeniably one of the most critical geopolitical and economic bottlenecks on the entire planet, especially when it comes to oil transit. By reaching a ceasefire or even just a de-escalation agreement in this specific maritime corridor, a massive risk premium was instantly wiped right off the price of crude oil. Unlocking this geopolitical bottleneck rapidly slashed energy input costs for US manufacturers, and that immense relief flowed directly into those incredibly low PPI numbers we just talked about.
Moving into part three, the greenback stumbles.
So, with inflation fears suddenly cooling off thanks to cheaper energy, the financial dominoes started falling rapidly across different asset classes, and the very first major casualty of this relief? The US dollar. See, massive disinflationary relief is phenomenal for stock prices, but it acts like pure kryptonite for a currency that heavily relies on the expectation of high interest rates to maintain its strength. The DXY, the US dollar index, completely broke down, briefly falling below the critical 100.6 support level. Why did this happen? Because investors instantly started pricing in Federal Reserve policy easing. They're betting the Fed just won't need to keep interest rates punishingly high anymore. Simultaneously, because central bank policies are suddenly diverging, like the European Central Bank indicating they might stay tighter for longer, capital flowed quickly across the Atlantic. That pushed the UR-USD pair up 0.74%, trading right around the 1.1430 mark.
But before we write the absolute obituary for the US dollar, it's really crucial to acknowledge the floor that's currently holding it up. Federal Reserve official Kevin Warsh delivered a very firm, hawkish counter-narrative to the market's pure optimism. He stated unequivocally, there is no leniency if inflation remains high at other benchmarks. He's looking directly at that sticky core PPI we mentioned earlier. This specific, strict stance from the Fed is acting as the only structural floor right now, keeping the dollar from going into a total freefall.
Let's look at part four, gold's tug of war. Okay, so picture this. We've got a falling dollar, easing headline inflation, but lingering, highly complex global risks. Where does the smart money go to hedge its bets in an environment like this? It goes to gold, for sure. The asset is facing heavy volatility and intense sell-offs, yet it is stubbornly clinging to historic highs, oscillating wildly between $4,000 and $4,100 an ounce. The market is aggressively trying to figure out exactly how to price in these conflicting global signals, and that's leading to some truly dramatic price swings for the precious metal.
We can literally weigh these opposing market dynamics against each other. It's a massive tug of war. On one side, you have the downward forces. Investors who have successfully written gold all the way up to these historic highs are logically cashing out. They're taking their short-term profits while they can, which makes total sense. But pulling incredibly hard in the exact opposite direction are the upward forces. Cooling inflation inevitably means lower US Treasury yields. When those yields drop, it reduces the opportunity cost of holding a non-yielding asset like gold, making it fundamentally way more attractive to long-term investors.
But there is a vital tiebreaker here keeping gold elevated against all that heavy profit-taking pressure. It's serving as a geopolitical shield. Iran has made explicit threats to blockade energy ships in direct retaliation to US port blockades. So even with the Hormuz ceasefire helping energy prices right now in the short term, the broader regional tension remains a highly unpredictable powder keg. This persistent underlying threat solidifies gold's status not just as your standard inflation hedge, but as a strategic, absolutely necessary defensive asset in a highly uncertain world.
And finally, part 5, party on Wall Street.
The falling dollar and the rapidly cooling headline inflation have culminated in an absolute explosion of bullish sentiment in the equities market. S&P 500 futures are surging by 1.1%, and in the world of broad market indices, that is a massive, definitive move upward. The risk-on switch has clearly been flicked by institutional and retail investors alike, though it is worth pointing out that while the tech-heavy Nasdaq 100 is also climbing on this news, it's definitely facing a bit more technical resistance in reaching new historical peaks compared to the broader, more diversified S&P 500.
So what exactly is fueling this record-breaking party? Let's rapid fire through the massive positive catalysts driving these equities higher. First off, the sharply decelerating inflation we've thoroughly unpacked today. Second, the Q2 earnings season has kicked off with an absolute boom. Specifically, we've got to highlight major financial powerhouses like Morgan Stanley and Goldman Sachs. They delivered quarterly earnings reports that completely shattered analyst expectations. It really proves that corporate America remains highly resilient, totally brushing off any earlier fears that high oil prices would eat into their bottom lines.
And crucially, this financial jubilation, it is not confined to Lower Manhattan. A vivid sea of green is actively sweeping across global indices throughout the Americas, trickling right into Europe and beyond. The positive macroeconomic shockwave of the US PPI data has genuinely ignited a synchronized global stock market rally. It's quite a sight.
Bringing the whole shebang together, let's take a look at the Fear and Greed Index, which is perfectly mirroring the upward trajectory of the S&P 500 right now. It beautifully summarizes the complex psychology of the current market. Investors are actively dumping the US dollar to buy up equities because they're growing highly confident in an economic soft landing. You know, that Goldilocks scenario where inflation cools down to normal levels without triggering a painful recession. Yet, simultaneously, they are hoarding gold at record prices as their geopolitical insurance policy. It's a fascinating, deeply strategic dual approach, maximizing aggressive profit on the front end while heavily fortifying their portfolios against worst-case scenarios on the back end.
Which brings us to the end of today's explainer, and leaves us with a very important, provocative question for you to consider. In this rapidly shifting, highly dynamic risk-on era, how will you adjust your own financial strategy before the next wave of macroeconomic data hits? The dominoes have fallen perfectly for the bulls today, but hey, in the global financial markets, they are always being set up again for the next big catalyst. Take some time to think about how you're balancing your aggressive growth equities against your vital defensive assets. Keep learning, keep analyzing, and I'll catch you in the next explainer.